Let me start with something strange. Today, thousands of people in India are suddenly searching, what's the gold rate today? Why? Because gold is falling sharply. Not just a small correction. This is one of the biggest falls in decades. Gold has dropped more than 8 to 10% in a very short time. And in India, prices have fallen by thousands per 10 grams. Now here's the confusing part. This is happening at a time when geopolitical tensions are rising, oil prices are increasing, and global uncertainty still exists. Normally, gold should go up at this time, but it's not. So the real question is, why is gold falling when it should be actually rising? And more importantly, how can an index trader actually make money from this? Most people believe gold moves based on fear. More fear, gold goes up. Less fear, gold goes down. Simple. But the markets are never that simple. Because right now, fear is actually increasing and yet gold is falling. So something deeper is happening. To understand this, you need to understand one thing. Gold does not generate any income. No interest, no dividend, nothing. So when interest rate rises, money starts moving away from gold into assets that generate yield. And that's exactly what's happening right now. Because rising oil prices increases the inflation. Higher inflation makes central bank increase its rate. And when rate hike is expected, gold becomes less attractive. Now here's another level. Gold is priced globally in dollars. So when US dollar becomes strong, gold becomes expensive for other countries. So the demand drops, price falls. And right now, gold is getting more strength and bond yields are rising. And both of them are negative for gold. Now this is something most retail investors never notices. Sometimes gold doesn't fall because it's weak. It falls because people need cash. When market becomes volatile, institutions start selling whatever is liquid. And gold is one of the most liquid asset in the world. So what happens now? They sell gold to cover the losses elsewhere. That creates a forced selling pressure. Let's connect everything. Gold is falling because interest rate expectations are rising, dollar is strengthening, liquidity is tightening, investors are booking profits after a strong rally. This is not random, it's a macro shift. And whenever macro shifts, money flow changes. Now comes the real question. Why should a Nifty or a Bank Nifty trader care about gold? Because gold is not a commodity, it's a macro signal. And smart traders don't just trade the charts, they trade the money flow. When gold falls due to rising interest, two things usually happen. The first one is cost of capital increases. Second, liquidity in system reduces, and this directly impacts equities, especially small caps, high valuation stocks, momentum driven rallies, which means equity market becomes fragile. When gold is falling due to rate expectations, market often become very volatile and it shows sudden sharp moves and it even fails all the rallies that it does. So what should a trader do? Instead of blindly buying at breakouts, you should actually look for failed breakouts, resistance rejections and weak pullbacks. And this is where short side setups becomes very powerful. Gold crashes are rarely isolated. They often signal a broader volatility expansion. And volatility increases, options becomes interesting because premium expands, intraday ranges increases. So instead of looking at directional trading, you can look at straddles at high volatility, quick scalps in option buying because markets are going to move very fast. When interest rate rises, certain sectors get hit more than others. For example, banking reacts differently, IT reacts differently, and small caps get hit harder. So instead of trading index blindly, you can track where exactly is the money moving. Because falling gold is not about gold. It's about capital shifting across markets. Now let's go back to where we started. People are searching gold rate today. And why does that matter? Because it shows retail attention. And retail attention usually comes after the move has already happened. Which means the real move is not in gold anymore. The real opportunity is in how other markets have reacted to it. Most traders focus on what is moving, but the professional focus on why is it moving. Because once you understand the why, you can predict the next move. This is not a gold story. This is a liquidity story. And this is a rate cycle story. This is a macro shift unfolding in real time. And in markets, money is not made by reacting late. It is made by understanding it early. Because by the time everyone is searching for gold prices, smart traders are already positioned somewhere else.